So here's another video on options for an introductory to finance course, typically for an undergrad at like Concordia, Penn, McGill, etc. And you're going to know how do we solve exam-like questions, especially those that can appear on your final exam, on your midterm, assessments, etc., how to do so effectively. In this video, you're going to learn how to draw a payoff table, the most important tool you will need to solve an options question. And then we're going to be pretty cool and we're going to draw a payoff diagram to kind of double down on the teachings or on the knowledge or on the methodology that I'm showcasing. Okay, so hopefully this helps you out and hopefully we can work on this together and you'll be empowered to know how to solve these really easy exam questions like that ask. Okay, so let's jump into it. So Sarah created the following portfolio, and the following portfolio, it consists of two positions. Okay, it consists of two specific positions. One which will be a sale, all right, a sale of a call option. So we're going to highlight sale, we're going to highlight call option on PepsiCo stock with a strike price of $28. Super important. Then she also purchased three, this is important, put options on PepsiCo with a strike price of $41 each, okay? Let us also assume that PepsiCo has a price of $30, right? At expiration. So this will be the price of PepsiCo when these two options, right? These two positions will expire, okay? So we want to know what's the payoff of Sarah's portfolio. That's our mission. And really, it's always going to be our mission with these types of questions, solving for this general idea of the payoff or even the profit. And I really can't stress how easy this is. This is going to be amazing easy. So I'm going to show you what are the steps to take. And literally like throughout any question that you have on options, you're always going to have to draw a payoff table. Like even PhDs do that. It's the fail-proof way to go about this. And it actually becomes really easy the more you practice. And my methodology kind of makes sense low key. Like I don't want to brag, but it really does work. So let's go about it. Let's do this together. So the first thing is you want to highlight the following. I guess we'll go all the way here. And the first thing is we're going to highlight our columns. Our first column is going to be our positions. So the different positions that we're going to take. All right. And then the second set of columns will be the different prices. All right. So let me just do it like this. In the second set of columns that we're going to be looking at is we're going to look at a simulation of all the different stock prices that we could have. Now, in this question, they're really only asking about one specific stock price. But if you look at my other videos, we could do a simulation on all the different stock prices available to find the maximum optimal point to earn the highest payoff. But in this question, I'm not gonna put you through the torture. I'm just gonna make you look at the specific stock price that they're asking to check out. So in this case, we're only gonna look at the stock price of $30. Okay, but in other questions, you may have to do many more than just that. So we have our stock price. All right. And then in terms of your rows, what you're going to do is you're simply going to highlight two categories of rows. One will be literally all of your positions, which are highlighted right here. So your sale and your purchase of these two different positions. And then it'll also be your payoff. We want to figure out what's the total payoff at that specific stance or what is the optimal payoff to be had. So in this case, we have two distinct positions, which is going to be the sale, right, of our a call at $28. I'm just writing keywords because we don't have the most space out there. And then this one will be buy 3 puts with a strike price of $41, okay? And then obviously the last segment would be the payoff. We really do care about the payoff. And it's gonna be as easy as that. That's literally all that you gotta do. And in this question, I guess you don't even need to draw a payoff diagram because we're gonna be extremely static and we're only gonna look at one instance, which will be the price at expiration. You don't need to look at any other instances because they're telling you, dude, that's the price that you're gonna deal with. That's when you're gonna execute. So we wanna know what will be your payoff when you execute, okay? So let's think about this. If you had a call, all right, if you had a call, and what's a call option? A call option is the right to purchase an underlying asset at a specific price for a specific amount of time. So to put this in simple English, in this question, they're telling you that you have the essentially a call option that had the exercise price of $28. So you had the right to purchase this stock price at 28 bucks. And what's interesting here is that, well, if you have a stock price, right? The stock on PepsiCo, right? It's selling at $30 right now, and you have the right to buy it at $28. What option will you go for? Will you buy it at the market price of 30 bucks, or will you use your option to buy it at $28? Now, any rational human being will say, you know what? I'm gonna save a few bucks and I'm gonna buy it with my call option. Your call option is at 28 bucks, such that your actual payoff is $2. You ended up saving $2, right? In savings. That's awesome. So here you would have $2 as your payoff. However, when we are selling a option that we had, we are foregoing the opportunity to make that saving. We are foregoing the opportunity to make those monies, you know? And in this case, how do we try to, I guess, qualify that? How do we try to signify that? Is by simply putting this as being minus $2. So we lost that opportunity. So that is a loss. So it's minus $2. Okay. Now let's move on to the purchase of 3 put options on PepsiCo stock with a strike price of $41. So what is, all right, what is a put? A put is the right to sell an underlying asset at a specific price for a specific amount of time. So in common, like layman's talk, or in layman, I don't know. To make this simple, essentially this means that, let's say PepsiCo stock right now is trading at $30 and you have a put option. So you have the right to sell this PepsiCo stock at $41. That's amazing. So you either have the opportunity to sell the stock at 30 bucks or sell the stock at 41 bucks. Where will you make the most amount of money? Well, of course, you'll make the most amount of money if you sell PepsiCo stock at $41, because you'll be able to sell the stock at a higher price than the market. So people will have to buy it off you at that premium. That's amazing. So you'll be able to make, right, if you buy these put options, $11. This is crazy. $11 per put. It's amazing. And notice that you bought 3 puts. That's crazy. So if you bought 3 puts, all right, that means that your total payoff for these 3 puts will be $33. That's insane. That will be your total payoff, your total benefit of essentially having these put options, which is dope. So in this case, if you want to find the total payoff for for PepsiCo, for Sarah's portfolio, all we have to do is we have to add A and B. And this would essentially be C. So C is equal to A plus B type of thing. All right. So to find your payoff, you just add, add your rows together. I don't know. I tried to find a way that's like cute to say it. It's simple. You add them up together. It's easy. All right. So minus 2 plus 33 gives you 31. All right. So your total payoff for Sarah's portfolio, it's $31. And it's as easy as that. We finished the question. Okay. We finished the question literally as quick as that. Now, at the beginning of the video, I mentioned this notion of drawing a payoff diagram, right? And thinking about profits and literally finding different stock prices to use to simulate where our payoff would be optimal. In this specific question, we didn't have to do that. The reason why we didn't have to do that is because they already told you, they literally cuffed you with a specific price, the one of $30, right? The reason why this is important is because at $30 at expiration, that being the stock price, well, there's no simulation that needs to be done. This is the price no matter what, and you will exercise your option at that time, okay? And if you were to exercise your option at that time, here's your payoff. And it turns out that our payoff isn't so bad. $31, I mean, I'll take it, why not? $31, that's a meal, okay? I'm down for it. Now, all jokes aside, I hope this helped you out. I hope this gave you context on how to solve a multiple choice question, most probably, that may be seen on an exam, that may be seen on an assessment, homework, or a project. So once again, you can run through all of Eastman Helps' website, all of Eastman Helps' YouTube channel, and literally just look the thing up on like Facebook or Google. You're gonna find an abundance of content to help you prepare and do amazing in your courses. So I hope this helps. And yeah, I'll see you next time. And yeah, continue working really hard. You're awesome. And there's no reason why you shouldn't be able to get really amazing grades if I am able to make sense of this stuff. Like I'm a fool, right? I'm sure you're way better off. You got this. Okay. See you next time.